even if the Fed thought a severe recession was coming, it wouldn't admit that. It would try to put a smiley face on it and hope that positive talk would mitigate the severity of the downturn. But we're going to have a major economic contraction because we have to work off really 20 years of excesses that were the consequence of artificially low interest rates. I mean, the excessive debt and consumption and speculation has come at the expense of serious damage to the underlying structure of the economy. And all of this has to be worked out one way or the other. And so it's going to be a very painful process that is going to be elongated by government's efforts to mitigate it and get in the way.
In a world where economics takes center stage, the skill of forecasting becomes invaluable. Economist Peter Schiff has boldly ventured to make a daring prophecy, asserting that the Federal Reserve's battle against inflation is not only a losing endeavor but has already been lost. Despite the stock market's rally, with indices like Nasdaq, S&P 500, and Dow Jones experiencing growth, Schiff remains steadfast in his bearish outlook. The Federal Reserve has not yet initiated rate cuts and has even hinted at prospective rate hikes. Nevertheless, the market appears unconcerned and disbelieves the possibility of further rate increases, leading to a sense of relief. However, Schiff views this optimism as misguided and considers the current market rallies as nothing more than bear market rallies, overlooking the impending exacerbation of inflation. Despite the market's apparent belief that the Federal Reserve has inflation under control, Schiff firmly insists that the reality is quite the opposite. He believes that the Federal Reserve has lost the battle against inflation, warning of the potential consequences to come.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
But I think it's all the weak economic data that continues to come out, particularly out of the manufacturing side. But I think investors are looking at all this data and concluding that the Fed is done hiking. And even if it's not done, there aren't many hikes left. And the data is so weak that the markets are starting to price in cuts. And it's the expectation of rate cuts that I think is responsible for the market. And I also think investors are concluding that even if the Fed's rate hikes are not enough to reduce inflation, that a recession will do the Fed's job for it. That if we finally get a big downturn in the economy, particularly in the labor markets, that's going to bring the inflation rate down to 2% or lower. And so the markets are, excited about that and starting to price that in. But I think they're completely wrong. I think they're correct in that the economy is weak, but it's not going to reduce inflation. I think if anything, the next recession is a catalyst for a leg higher in inflation, as much larger budget deficits result in even more money printing and a real return in earnest to quantitative easing. In fact, I think that just the widening budget deficits and the explosion in the net interest cost to the government is going to cause the Fed to step up the money printing. So I think it's going to be stagflation. It's going to be a weaker economy, but much stronger inflation. And that is not a positive environment for the markets, particularly a lot of the growth-oriented type tech names, the types of stocks that investors should be buying that are really inflation sensitive are the ones that they're still ignoring. The recession is the market's method of repairing the damage that was done as a result of all the malinvestments and misallocations that were a consequence of the Fed's manipulation of interest rates. But when the government tries to push back against that correction, it just elongates the process and makes it more painful, which is, what we've been doing. Every time we start to see a problem, we slash rates and print money. We just saw several large banks fail, and a lot more would have already failed had the Fed not stepped up and backstopped everything. But that doesn't mean we're out of the woods. I mean, all of the problems that resulted in Silicon Valley Bank or Signature Bank or whatever going under, those problems are there throughout the entire banking industry. All you have to do is think about all of the mortgage refinancings that occurred over the last 5 or 6 years, where you've got all these 30-year mortgages in the threes. That's great for the borrowers, but what about the banks that are holding all that paper? They're underwater. They're losing a ton of money on these mortgages. Think about all the commercial mortgages that were extended, where the collateral has collapsed, where commercial real estate values have been halved or down even more than that. So you have all this negative equity in all these loans that the banks are holding on to. Plus, the banks also have large portfolios of government, treasuries, where they own 10 to 30-year maturities, again, where they're collecting 1% and 2% interest in a 5% environment. So they're losing a lot of money on these loans. Meanwhile, everybody is loaded up with debt. Student loans now are getting close to $2 trillion just there. Credit card debt, record territory. Everybody has debt. Corporations, just went on a debt binge during the era of cheap money, and their balance sheets are at risk dramatically as all this low-yielding debt matures into a higher rate environment. And look at the federal government. I think interest on the national debt right now is $600 to $700 billion a year. That's double where it was about a year ago. By the end of this year, it'll be about $1 trillion. By the end of next year, the U.S. government will be paying $2 trillion a year in interest on the national debt, which will be about $35 trillion by the end of next year, headed for $40 trillion, probably in another year or two from there. And that's if interest rates don't even go up. What if rates keep rising? What if they go to 7% or 8%? So this is a huge debt bomb that's going to explode.
Adding to the bleak outlook, Peter Schiff dismisses Federal Reserve Chairman Jerome Powell's inflation predictions as grossly misguided. Powell envisions inflation meeting the Fed's 2% target only by 2025. However, Schiff refutes this claim by emphasizing that a lot can change in the next 2 years. The potential for a significant recession could trigger substantial money printing, causing inflation to skyrocket instead of receding. The economist contests Powell's need to project 2 years into the future to forecast 2% inflation, viewing it as a lack of confidence in the accuracy of the prediction. This uncertainty implies that even the Federal Reserve itself is unsure when or if inflation will subside to the desired 2% level. The situation remains highly unpredictable, and the possibility of inflation persisting at elevated levels is a major concern.
Banks are losing their deposits because
Absolutely.
they can't pay interest. And so people are yanking the money out of banks and buying money markets. So they're lending their money to the U.S. government at 5%. And so the banks are losing all their capital in addition to the value of their loans going down. The whole banking sector is completely insolvent, thanks to what we've done over the last decade or so by loading up these banks with all this long-term, low-yielding debt. And we had all these deposit insurance, so nobody really cared about what the banks were doing with their money because it was all insured by the government. But now, though, that people have seen these large banks fail, and the government has said, look, we're not necessarily going to cover your bank if you have more than the FDIC amount. It's a case-by-case situation. We're going to have to evaluate the systemic impact. The message that sends is if you're a customer of a small bank, a regional bank, a community bank, and you've got a large account, you just better get your money out. There's no reason to leave it there. They can't pay you enough interest to compete with a money market. And what if the bank fails? You may be, SOL. And so there's a huge run, on these banks. So they're all going to fail. And the government, obviously, if it wants to bail out every one of these banks, the only way it can do it is by destroying the value of the deposits because of massive inflation. Because the money to bail out the banks has to be created by the Fed. It's the only way they're going to get it. The FDIC doesn't have any money compared to the trillions of deposits. And so it doesn't even matter if your bank fails. You're going to lose money if you have a bank account, because either the bank's going to fail because the government doesn't bail it out and you're going to lose your deposits, or the government bails out your bank and your deposits lose their value because inflation destroys the purchasing power. So no matter what happens, people are going to lose a tremendous amount as this banking crisis unfolds. Initially, a lot of the inflation, as it worked its way into the real economy, went through financial assets. It went into the stock market, into the bond market. And now that inflation has already migrated into the real economy. It's in consumer goods, it's in services, and it's there to stay. It's just taking hold, and it's going to build on this momentum. So we're going to have very, very high inflation for many, many years. And the government can lie about it and try to hide it beneath these rigged CPI numbers, but it's now so bad. It's just that the markets haven't come to terms with that yet. Just like they initially thought inflation was transitory, then they thought, okay, it's not transitory, but the Fed can easily put this genie back in the bottle. They're going to find out that that expression is here for a reason. They said, don't let the inflation genie out of the bottle. Why? Because it's very hard to put it back in. And the Fed made the mistake of letting it out of the bottle because they were too afraid of what might happen to the economy if they tried to keep it contained in the bottle. But now that it's on the loose, there's no way. And in fact, even Powell just last week in his speech acknowledged that inflation is probably not going to go back to 2% until sometime in 2025. But of course, he's wrong again. I mean, it's not going to be anywhere near 2% in 2025.
The markets are still recovering from Thursday's substantial stock sell-off, triggered in part by strong U.S. data and rising global yields. Short-term yields in the U.S. and U.K. continue to reach new highs, while longer-dated maturities are also on the rise. The U.S. benchmark 10-year yield surpassed 4% for the first time since early March, indicating a potential easing of recession worries. Economist Peter Schiff's criticism of Federal Reserve Chairman Jerome Powell's inflation predictions is not new. Schiff firmly believes that the Fed's battle against inflation is bound to fail due to certain neglected factors such as artificially low interest rates, quantitative easing, and government deficit spending. He warns of a looming U.S. dollar crisis and escalating national debt, highlighting the flaws in the Fed's approach. While forecasting is valuable, Schiff's perspective offers a sobering counter-narrative to the current market optimism. The uncertainty surrounding key upcoming releases, such as Friday's NFP and next week's CPI, adds to the complex economic landscape. As we await the unfolding of events, the truth of these economic forecasts ultimately lies in the hands of the future. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.